Welcome to the Reasonable Compensation What, Why, and How. In this presentation, we are going to be going over what the goals are of reasonable compensation. Why do we have to do reasonable compensation? Why is it important? If you own an S Corp, you'll find out that it's very important and very much tax savings to have an S corporation. There are certain needs that the IRS requires to have that compensation, and we will be talking about how to calculate it, how much tax applies, and what the needs are for that. First of all, we'll do a little bit of background. What is an S corporation? An S corp, according to the IRS, is an entity organized as a corporation or a limited liability electing to be taxed as an S corp. In other words, you can be a PA, you can be an LLC, you can be a C corp, or you can be an S corp. Any of those entities can elect to be taxed as an S corp. Now, an S corp is a separate entity from the owner. The owner and the S corp have to be considered two separate and distinct entities. The S corp doesn't pay any taxes directly. The income or the earnings from the S corp go on a separate tax return. That tax return is boiled down to a single page called a K-1. That K-1 is then transferred on to the owner, and the owner reports the income from the K-1 on their personal tax return. The owners also are employees of the S corp that they own. As an employee, they have to be paid a reasonable compensation. That makes sense, right? If you hired somebody to work for the company, you would have to pay them a salary. Now, as an owner, they're also entitled to the profit. So you'll see later on that they're going to be getting two different streams of income. One is a wage for being the employee of the company, and the other is as the owner of the company. Due to the fact that they have to have payroll, that there are quarterly payroll tax returns that must be filed for the federal IRS. In addition, if you live in a state where there's a state income tax, then state payroll tax returns need to be filed as well. So why do an S corp? What is the reason for doing it? Why do we emphasize using an S corp? Well, I have a little example here that I pulled in from another webinar that I've done. And if you'll just follow along with me, if you look in the upper left-hand corner, you'll see just an example. Now, the numbers in this example are strictly numbers that I've used that will be easy to work with. They're not necessarily any indication of how well or how poorly you might be doing. They're just simply numbers that are easy to work with. So if we have a company that, say, generates $150,000 of gross income, they have $50,000 of expenses, then they have a net profit of $100,000. Okay? If you are a limited liability company, then your profit equals your wage. Well, what does that mean? That means that the $100,000 is not only taxed for federal income tax, it is also taxed as a payroll. So if you look at the chart here, you'll see that the federal income tax runs between 10 and 37%. So for this example, we're just going to assume 25%, just the number in the middle. Now, if you've ever received a paycheck from an employer, you know that Social Security tax and Medicare tax are both withheld from the check. What you may or may not know is that your employer had to match Social Security and Medicare tax. So there's another 6.2% and another 4.5%, 1.45%. And if you are the owner of the company, you are the employer, therefore you have to pay those matching taxes. So when you look at that, those taxes add up to just about 15%. So when you look at that total, you'll see that your income of $100,000 after tax is about $59,700. Okay, so let's say we take your LLC and convert it to an S corp, or let's say you just formed an S corp. Well, as an S corporation, as I mentioned a minute ago, you have both reasonable wage plus profit. Well, let's assume that a reasonable wage for this employee is $30,000 a year. Okay, so you get your wage of $30,000, but you also get your profit of $70,000. So you see your total income is still the same at $100,000. Now, federal tax is federal tax. You're going to have to pay income tax on your earnings no matter how they come to you. Social Security tax and Medicare tax and matching taxes are strictly payroll taxes. So as a wage, you have to pay those taxes. As a profit, those are not taxes that you have to pay. So you can see there's all zeros down in there for the payroll tax as a tax on your profit. So there's no tax. So at the end of the day, your take-home pay is $70,000 and you're saving almost $11,000 just by being an S Corp. So this is the old working smarter, not harder. Okay, so what is reasonable compensation and why is this important? So reasonable compensation is what you would pay someone else to do the job that you're doing. If you were to hire somebody, what would you pay them? Or what is the fair market value? In other words, out in the marketplace today, what would somebody else be paid to do the job that you're doing? Now keep in mind, you're both an employee of the business and you're the owner of the business. As the employee, again, you must pay yourself a reasonable wage. It would not be reasonable not to pay yourself. Who would work for you and not take a check? That wouldn't make any sense now, would it? So if you look at it, if you look at the little graph to the right, you'll see how you pay yourself as an S corporation. You have their business bank account, and you pay yourself two ways. You pay yourself via payroll, salary, as we've been talking before, and you take the profits as the owner. Those profits are then deposited directly into your personal bank account. So you see the funds go from the business to the individual in two separate ways. So what's the difference between salary and profit? Why is that important? Well, on the salary side or the paycheck side, or another way of looking at it is, what does CPA tax advisors do for you? Well, we calculate the reasonable compensation for the services provided. We prepare the payroll tax returns every quarter. We withhold the Social Security and Medicare tax from the employee, which is you, and we do the matching tax from the employer, which is the business that you own. We calculate the state unemployment tax, we calculate the federal unemployment tax. Wages, now the gross wage, if you're paying yourself $30,000, for example, as I mentioned in the last slide, those wages would be deductible to your business. The employer portion of the payroll tax, in other words, the matching Social Security, the matching Medicare tax, the state unemployment, and the federal unemployment are all deductible taxes to the business. At the end of the year, you, as an employee, would receive a W-2. In addition, we would file what's called a W-3 to the IRS. And there's no need to go into what a W-3 is, but it's something that we would do to keep you compliant. Now, on the distribution side, a distribution is simply, what'd you make this year? Well, you can take that money out of your business anytime for any reason. That money that you take from your business is your money. There's no taxes that are withheld from that. The payment, you do not get a tax deduction for the money that you take out as a distribution. It is reported as a distribution, but it's not taxed. There's nothing that we have to file for distributions. There's no quarterlies. There's no annual return. It's simply money that you have earned as the owner of the business and you're taking a profit. Finally, any money that you take out of the business for any reason that is not business related, in other words, if you pay your rent or your mortgage or your car payment from your business, that is considered a distribution. It is not deductible to the business. So why does the reasonable salary matter? Number one, because the IRS says it matters. Well, why does the IRS say it matters? Let's just look exactly at what their terminology is. Distributions and other payments by an S Corp to the owner must be treated as wages to the extent the amounts are reasonable compensation for the services rendered to the corporation. In other words, if you work in your business, the amount of work that you're doing for your business must first count as reasonable salary. Then the rest can count as distribution. I know it's very tempting to keep that reasonable salary low or zero to avoid all the matching taxes, but that wouldn't be reasonable, would it? Now, what does this mean to you and I as business owners? Well, it means that first of all, the IRS is increasing its audits by 50%. They started last year. So they're going to look closely at small businesses, a lot closer than they have been. If they determine that you have not paid yourself a reasonable salary, they can switch the amount to what they consider reasonable. Now, if they consider it reasonable, this amount to be reasonable, for example, I had somebody who did not pay himself a wage at all. The IRS came along and said that the reasonable salary was $80,000 a year. Well, in this particular case, he had to pay 15.3% on the $80,000. He had to pay interest at prime plus 3%, and that interest goes back to the time period in which that payroll should have been paid. So if you're audited today for 2019, you're already 3 years behind. So there's going to be 3 years of accrued interest. So that can add up to some serious dollars. In addition, they can assess a 35% excise tax and a 20% accuracy penalty. And if they decide that this was willful neglect, they can add another $5,000 on top of that. Well, if you were to hire somebody to help you challenge an audit, you're looking at $3,000 to $5,000 in professional fees on top of that. You can see that the penalty, the pain of a penalty, is much worse than the cure of simply doing a reasonable salary. Now, what we have been doing when we work with you as a business owner, we've been asking, well, what have you been earning this year? Let's try and figure out what's reasonable from those earnings. Okay, well, that's important, but it's not the only factor in determining the reasonable salary. You've got to look at what the other factors are in what you do. In other words, what's your training and experience? Two realtors can have totally different training and experience. Another thing that goes with that that's not really mentioned here is what's your location. You've got to believe that a realtor in Manhattan is going to be paid a lot higher amount than a realtor, say, in Fort Myers, Florida, where we are here. What kind of duties and responsibilities, what things do you do for the company that may not be exactly real estate related? Do you do your own computer work? Do you hire somebody to do it? Do you do your own web pages? Do you do your own bookkeeping? Those kind of issues. How much time and effort do you devote to the business? Are you full-time? Are you part-time? Are you somewhere in between? That's all part of the question. What is your distribution history? How much have you been taking out of the business every year in distributions? Is what you're taking out this year reasonable comparative to the prior years? How much do you pay other employees if you have other employees? If you own a company that has, let's just use my field, for example, a CPA. If I hire a CPA, am I paying my CPAs more than I'm paying myself? Would that be reasonable? I don't think so. How do you pay bonuses? Do you pay bonuses? Is there a written plan? What's the market paying for those services? Is there a written agreement, as I mentioned a minute ago? Do you have a formula for determining compensation? Is the formula the compensation, or is there just a straight salary? These are the issues that are looked at when determining reasonable compensation. Now, we did have one audit in that regard, and the auditor was actually looking at the gross income. We were able to pull in these 9 factors and say that, hey, she didn't spend all of her time doing that. So we were able to keep the reasonable compensation that we had where they wanted to double it. Let's take a look at a few reasonable compensation cases in the courts. Okay, this first one is veterinary surgical consultants. Now, this was a gentleman, he had a full-time job making a six-figure income, and on the side, he had a veterinary practice. He was a vet, okay? Now he said, well, my other job pays me a really good salary. In fact, it's pretty good salary. I don't think I need to pay myself at all from this company because I'm already covered in my wages from my other job. Well, the IRS said, well, we don't really care about your other job. What really matters here is how much you're paying yourself for this job in this business. Ended up, went to tax court, and the verdict was for the IRS, and he had to pay taxes on $563,000. Second case of Jolie versus the commissioner. Well, this one was a company where the owner didn't take distributions, but used company funds to pay for personal items. And he said, I wasn't taking any distributions, so I didn't take any salary either, and I shouldn't be penalized for that. Well, the IRS said, no, that's not true. Any money that you take out of the business for personal use is a distribution. And if you didn't take salary, then first they're going to classify it to salary, then they'll classify the rest to distributions. In this particular case, he had $315,547 reclassified to wages, and it cost him $48,278 in tax. Plus, he had to pay penalties and interest. David Watson was a professional, and he felt that as a professional, he could pay himself $24,000 a year, and he believed that that was reasonable. The IRS said, we don't think it's reasonable at all. So they took his earnings, they looked at the 9 factors, and they reallocated $379,121 to wages, to which he had to pay the payroll taxes, the matching tax, penalties, and interest. Then we have Sean McCleary. Now, we got to say we love Sean because he was the case method on how to do things right. Followed all the steps, did everything. The IRS said his reasonable salary was too low. He presented what he had, took it all the way to tax court, and the tax court judge said, sorry, IRS, he's right, and he didn't have to pay anything. Now, we just invested in this new software called RC Reports, and we use this RC Reports to help determine what is your salary. RC Reports uses a special proprietary software that will look at your wage from 3 different approaches. Number 1, it'll take all of these and come up with a reasonable salary. Number 1 is what we call a cost approach. In other words, what does the owner of the business do all day? And what is the value of those services? Okay, that's one way to look at it. Second approach that they look at is, what are the industry averages? If you're to hire somebody in that field, what would you pay them? The third approach is called the income approach. If somebody were to buy your business, what would they pay the workers in the business? And that would be the third approach. Now, RC Reports guarantees that they will cover in the event of an IRS audit. And I'll use a specific example for this one. We had a client who came to us, was not a prior client, was paying herself $42,000 a year. The IRS came in, audited her, said, we don't think $42,000 is reasonable. We think $90,000 is reasonable. And they wanted her to pay tax, interest, penalties, and everything on $90,000. The amount was pretty high. She came to us and said, hey, is there anything you can do? My current CPA says just pay it. Well, we don't like the just pay it atmosphere, so we went ahead and said, hey, we just got this software. Why don't you give it a try? So she went through the software, and lo and behold, it came out $44,000, slightly higher than what she said, but nowhere near the $90,000 that the IRS was saying. Well, we submitted all the documents to the IRS, showed them how it should be 42 might be a little low, but it was generally okay. IRS came back and said, well, we understand what you have there. I'll tell you what we're going to do. We'll take your amount, our amount, and we'll split the difference. And our response to that was, well, how about we don't? How about you look at our figures and you tell us where we're wrong? And lo and behold, the IRS said, okay, we'll take your figures. And the woman didn't have to pay any additional tax. So let's take a look at this software. We're going to go through just a couple of screens to see what it looks like. It's pretty simple to use. It's very easy, and hopefully it will answer all of your questions. So here's the first screen, which is a software overview, okay? So what you're going to do, and I'm sorry for that last slide, it got a little bit out of order, but what we're going to do is we're going to look at first, what state are you in? That should be a pretty easy question for everybody to answer. What county do you live in? And how many hours a week do you work? Okay, those should be fairly standard questions. Now, the IRS doesn't care if you work more than 40 hours, uh, and I'm sure most of us business owners, 40 hours would be a dream to work that few a week, but that's the cap. That's where they cut it off. You can work less, but they don't care if you work more. The next thing they want to do is to look at the different types of tasks that you could have. Now notice there's maintenance, administrative, marketing, finance, etc., etc. Now what you're going to do is you can see the highlighted area right now is the marketing area. I skipped over a couple of them on top. Let's use a realtor, for example, and let's just say that we went to the very top one. Well, not too many realtors are going to have maintenance, janitorial type functions. So they probably wouldn't select any of those that are within there. But if you're looking at the marketing, you can see that there are 4 different options that the software has for marketing. And the green highlighted one, that's the one that we felt would be closest related to what a realtor would do. So you could select one of those, you can select several of those, however you want to be. The more detail is always better. And of course, that's an accountant talking. So we love the details, and the more detail you can have, the better you will look in an audit, and the more reasonable your wages will be. Okay, so that's the software. That's an overview. So you enter all this information, and what happens? So it prints out a report. So the estimated reasonable compensation for this person, $55,304. How is that broken up? Well, you can see all the little functions on the right-hand side. You can see a pie graph for how it's all determined. It's all put together. It's very neatly done. There's a couple of other pages that go with it that show the court documents that support this, that show a glossary, and it even gives the owner a legal annual minutes document that they can put in their folder and say, here's what we used, that we decided that the owner of the business should be able to earn a year just in reasonable salary. Remember, they can take as much distribution as they want. There's a few other screens. Not having the ability to flip to that right now makes it a little bit difficult here, but if you call our office, we're happy to work with you and set you up for reasonable salary. So what are the types of taxes that are accounted for with your compensation? Well, when you get a paycheck, you'll notice there are 2 types of taxes that We started to talk about these earlier. There's payroll tax and there's income tax. Let's start with payroll tax. Payroll tax is fixed. If your salary is $10,000, your Social Security is 6.2%. If your salary is $50,000, your Social Security is 6.2%. If your salary is $100,000, your Social Security is 6.2%, et cetera, et cetera, et cetera. Now, Social Security does cap at a certain amount. Medicare doesn't. Federal unemployment is $42 a year. State unemployment is give or take $200. Here in Florida, it starts at $189 a year, and then it can go down from there, but it won't go up unless there's a change in legislation. So there's your payroll taxes that you're looking at paying each year. And that's going to be strictly based on the reasonable compensation. Now, the tricky part, and the part where we help the most, where we come in and hopefully get the best bang for the buck, is calculating your income tax. Your income tax is what is withheld from your paycheck that then is credited on your income tax return when we do the return in February, March, or April. Okay? Now, it's an estimated amount necessary so that you pay the fewest tax possible when we do the tax return. Now, federal income taxes, as I mentioned before, are between 10 and 37%. Depending on what state you live in, it could be anywhere from 0, like it is here in Florida, to 13.3%, which is what it is in California. So if you're in California, you could be looking at paying over 50% of your income to taxes. If you're in Florida, the highest would be 37%. Now, if you're calculating income tax and you don't take out enough, you could be subject to interest and penalties. And as we mentioned before, those could be significant. This tax, again, I want to emphasize, is taken out of your paycheck and it's applied to your tax return, as opposed to your payroll tax, which is strictly an amount that's a fixed figure based on the reasonable compensation. So our new method of payroll, we're switching from the one size fits all to 3 different selections for you to make. Choose one of the 3, and I'll go through each one. First is the basic payroll, client provided payroll. This can be similar to ADP, Paychex, Gusto, one of the other payroll companies out there. That's simply where you call in your payroll, you fill out payroll forms, we calculate the tax and the unemployment, we file the forms, and that's it. Now, you're giving us the information. You could be subject to liabilities, penalties, and interest, depending on if that amount is not correct. The second option is called the enhanced payroll option. Now, with that option, we give you the RC reports. You take that, we come up with a reasonable compensation. Okay, great. So we know how much you should be paid per year as your payroll. Then we go and we look at your tax return and we calculate what would be a safe harbor. Now, safe harbor in this respect means how much tax do you need to pay to avoid penalty and interest. Now, if you have a phenomenal year, you may owe $1 million in taxes because you made $10 million in income, but you won't have any penalties and interest when you do the tax return. That's the goal with the safe harbor. Okay, so we file quarterly and annual payroll tax returns, and we review everything and make sure that you are not subject to any penalties or interest. Now, the Premier Payroll Package, in that package, we give you the RC report. You take the test, so to speak. You submit it to us. We'll kind of massage it a little bit, come up with a decent number. Then every quarter, you provide us with financial statements, whether those are on a spreadsheet or we like to use ProSeries or the back of a napkin. I don't really care, as long as it's some kind of reasonable estimated financial statements. From those statements, we'll do some tax planning. We'll figure out what your actual tax is. So if you're making that $10 million, that you're going to have $1 million in taxes, we'll tell you how much to pay each quarter toward those taxes. Okay? So we file the quarterly payroll tax return, and this is structured to avoid any liability, penalty, or interest. So in other words, if you follow this, you should be no refund, no amount due, no penalties, no interest. Now keep in mind, this is estimated, so it's never going to come out 0, but we do plan to keep that number as low as possible. Okay, so what are the next steps? So we're going to email you a choice card. If you're interested in this, we will email you a choice card in the next few business days. You select a payroll package, okay, from one of those 3 that we just talked about. You review and sign the engagement letter, send it back. We send you the reasonable compensation link by email. You take the test, so to speak, for reasonable compensation. You send it back to us. We review it. We go over it. If there's any questions, we'll give you a call or send you an email, go over a few things, make sure it's as sharp as possible. We review and complete all payroll tax returns, and then we just go on with the next payroll cycle. So therein is the entire reasonable compensation webinar. Since this is being recorded, we don't really have any questions or answer period here. But if you do have questions, please feel free to call us 855-740-1040, or you can email us at admin@cpataxadvisors.net. And again, we are CPA Tax Advisors. My name is Leo, and I've done this in conjunction with my employee, Rebecca. And we hope that you've enjoyed this presentation. And if you have any questions, feel free to get a hold of us. Thank you again.